unemployment rate is near a 50-year low, and the US added 225,000 jobs a month last year. Just about everywhere you look, people are talking about the strong jobs market.
Resilient, durable, robust, use the word you want to use.
The job market is absolutely solid.
It's one of the big reasons money managers say they're confident about gains for the stock market in 2024. But when you dig into the data, there are 4 serious problems that suggest the US jobs market isn't as strong as it seems. The labor force, data revisions, hours and wages, and unemployment claims. I'll explain. Most Americans, and even some market watchers, only pay attention to the big numbers when economic data are released. One of the main ones is the government's monthly jobs report, which has shown the unemployment rate below 4% since February 2022. But the historically low rate is actually masking some weakness, particularly in the number of people who are in the labor force. In December, the jobs report showed that 845,000 people had dropped out. That was the 10th largest increase in the number of people dropping out of the labor force since the Labor Department started tracking the data in 1975. Americans dropped out of the labor force in 8 out of 12 months last year, leaving the US with a net 694,000 fewer workers. The number of people dropping out of the labor force is also a reason why the unemployment rate is so low. That sounds strange, but the unemployment rate doesn't include people who have dropped out of the labor force. It's calculated by taking the number of people who are unemployed and dividing that by the total number of people who are in the labor force. Anyone who doesn't say they're actively looking for a job is counted as out of the labor force. And lately, the folks dropping out of the labor force have included more prime age workers, or those between 25 and 54 years old. The prime age labor force participation rate has fallen pretty consistently since September. The government also overestimated the number of jobs the US added in almost every month of 2023. The Bureau of Labor Statistics releases the non-farm payrolls report each month, which estimates how many jobs were added by American companies. But the report also tells us how many jobs its previous 2 reports were off by. In a typical year, some months are revised higher, meaning the BLS underestimated how many jobs were added, and some months are revised lower, meaning they overestimated. Last year, every month except October was revised lower. It was the first time that many months had been revised lower in the history of the survey, which dates back to 1979. Liz Ann Saunders, the chief investment strategist at Charles Schwab, told me recently that the US saw a similar pattern in 2007 and 2008, ahead of the global financial crisis. At the time, the labor market looked pretty good, Liz Ann said. What we know now with all the revisions is the backdrop was a lot uglier. And we've been seeing another reliable recession indicator from the jobs report, a decline in real wages and average hours worked. While average weekly earnings for Americans soared in 2021 and 2022, during the so-called Great Resignation, things reversed course at the tail end of 2023. Average weekly earnings for US workers fell in December for the second time in 3 months when adjusted for inflation. That was largely the result of a decline in the number of hours the average American was working. Reducing hours has long been an early recession indicator. It shows businesses are looking to lower their labor costs because they aren't making as much money, but they aren't yet ready to start handing out layoffs. The rise in the number of continuing jobless claims has also caught economists' eye. The number of people who continued to file claims for unemployment rose to the highest level since 2021 in mid-November, and has remained pretty high since then. The numbers have stayed under 2 million, which is low by historical standards. But the consistent increase in continued unemployment claims, even as initial claims for unemployment insurance have been very low, is unusual. It shows that people are having trouble finding work once they're laid off. And that's a sign that the labor market may not be so great for job seekers, which could explain why so many are dropping out of the labor force. So what does all this tell us about the US economy? Obviously, the labor market isn't falling apart, Liz Ann Saunders told me. But all of this weakness does show that there are cracks forming that you wouldn't pick up if you were analyzing the economy at the headline level. So as with everything, when you're thinking about how the economy and the labor market are doing, make sure you read the fine print.